So how safe is peer-to-peer lending? Look, really interesting question, and you've got to sort of start with first principles. So often what I hear when we're talking about, how safe this market is people have no idea around credit losses and the magnitude of those. So we could say, for example, well, what if credit losses were 20%? And what if credit losses were 20%? It would be a bloody terrible outcome, right? Investors would certainly lose all of their interest and some of their principal. But how realistic is a 20% loss rate? So let's back up the truck a little bit and talk about that. So for a start, with Squirrel money, 80% of our lending, in fact it's currently 90, but our policy's a minimum of 80% of our lending is to A and B risk grade clients. This is very much at the upper end of the New Zealand market, and it's what we would call, prime bank credit quality borrowers. They have a very, very low probability of default. In fact, the standard probability of default for those clients is generally around 1.1%. So that's your expected credit losses. Now, the worst economic event in New Zealand's modern history was probably the '87 share market crash. The economy tanked afterwards and pretty much hit rock bottom in 1992. At that time, the unemployment rate was around 10.5%. Now, typically, credit losses occur with loss of income. So I think the unemployment rate is a good proxy for the potential worst case scenario for credit losses. So at that time, 10.5%. But bear in mind that if you go back to 92, a lot of that 10.5% was in the provinces, the one industry towns where the business closed up and no one could get a job, and it didn't matter what you did, there simply weren't any jobs there. The freezing works, a bit more recent, but things like Feltex, carpet manufacturing, that sort of stuff. The reality is that the borrowers that we're lending to are typically in metro environments. They have higher incomes and they have reasonable levels of job stability. So 10.5% to me is a pretty extreme example of the sort of credit losses that we might expect from that group. But let's use it. Let's use 10.5. So the gross interest that borrowers are paying is around sort of 12.5 to 13%. Out of that, we're putting about 2% of that into the reserve fund, and another 2% of that goes to Squirrel money as its platform margin. So what that means is that investors are getting a return of 8.5 to 9%. Plus the reserve fund is in place to cover expected credit losses. Now, at the moment, we run that reserve fund at 4%. So there's 4% is available in the reserve fund. Plus, we've got about another 2% going into that reserve fund over a 12-month period. That gives us over a year about 6% that we could offset against expected credit losses. You've then got another 8.5 to 9% of investor interest. So combine that all together and you're up to about 15% loss rates before investors start to lose capital, before they start to lose principal. And what we've already talked about is that a pretty extreme level of loss rate would be sort of around 10%. So it just gives you a sense for the relative risk of this when you actually start to work through the numbers. Now, in terms of the worst experience of a peer-to-peer platform, the platforms haven't been around that long, but in the UK during the GFC, we saw expected credit losses get up to around 5%. And that probably gives you a reasonable proxy for what we might expect to see if there was some sort of major market correction in the market that we're in.